0.02%. We need some commentary on this market, and Michael Lee's here to do it for us. Michael, today's CPI report, consumer prices up 3.2% in the last 12 months. So we've got inflation going up a little, but the market is rallying quite strongly. You want to explain that?
Yeah, well, Stuart, what you need to look closely at is the core month-over-month inflation. We came in at 0.2%, which puts you at about 2.4% annually if you keep up that rate, which is very close to the Fed's 2% target. I think the entire market was on pins and needles, that we could get a miss and an acceleration of inflation in that core month-over-month number. Okay, we did not, and things look to be headed in the right direction. However, this price spike in oil only really happened in the second half of July, so it puts even more pressure on the next reading, because have we seen the end of the rate hikes from the Federal Reserve? And I think if we stay in this 0.2 month-over-month core inflation, I think we have. Okay, will inflation reaccelerate based on the price of oil rallying? So we don't know yet. We don't know if inflation is going to reaccelerate. The last time, 30, 40 years ago, when we were in an inflationary super cycle like we're in now, there was a double top in inflation. So the Fed cut rates too early, and inflation reared its ugly head again. I think Jerome Powell is very determined to avoid that. And this number coming in where it did, the market's taking it very well. But
in the immediate future, or I say till the end of the year, relieve our anxiety, please. You don't see, with inflation news like this, surely you don't see a major sell-off before the end of the year, do you?
Well, if we stay on these numbers, no. Right. Unless things really start to break in the economy, which is a possibility, but I don't think it's a probability in the next few months.
Does China make any difference?
$5.5 trillion in money markets on the sideline.
What about China? China is slowing down quite dramatically. Could that affect us and our market?
Well, I think that is good on the inflation front, right? Because less demand for commodities worldwide from China. They're a massive importer of all commodities, and then their lack of demand, frees up supply chains. And so I'd say that in the near term, because the inflationary pressures, to me, are the number one threat to our market. I think that's going to be help with those inflationary pressures to slow down in China.
Okay, I want a stock pick. I want the name of a stock that you would buy today, which is going to go up tomorrow and in the future. What is it?
Okay, so Truist Financial, they are not one of the too big to fail banks, but they're just below it. They're a massive bank, and the stock, the PE ratio on that is a little over 7, and the dividend ratio, dividend payout, is 6.5%. It's trading at 0.8 times book, where historically it's traded at about 1.2 times book. Okay, that implies a 50% move if it resumes to that, and then a price to earnings multiple of about a 12 or 13 is there more along the historic line. So if they don't make any more money, if their earnings stay flat and they just go back to normal valuations, you're looking at a substantial price appreciation in Truist, all the while getting a 6.5% dividend while you wait. Basically, the stock got crushed back in the Silicon Valley bank collapse, and it hasn't recovered whatsoever. And I think that's a bit overdone. They operate in a lot of a lot of the Southeast. It's a merger of SunTrust and BB&T. These are good banks. They're big enough to where I can't see them going out of business. And if they simply survive and return to normal valuations, you're going to see substantial price improvement on that. Even if it takes a couple years, like I said, there is a 6.5% dividend yield.
That's what got my attention. A 6.5% dividend yield on Truist. Now, you got my attention with that one. Thanks very much indeed. Mike Lee. See you again soon.
Thanks, sir.
Peter Doocy, pressed president.